Retail systematic trading suffers from a specific, highly repetitive structural error. When executing a trade on a breakout, the standard practice is to anchor the initial stop loss below the extreme low of the signal candle. Looking at this trading terminal, we see the mechanics of that decision. When a high-volume true C impulse candle fires, placing a stop at the exact bottom forces the position to absorb the maximum possible point risk of that entire block. In this case, 40 full points of NASDAQ exposure. That wide risk band severely degrades capital velocity. To simply clear a standard 1-to-1 risk multiple, the market has to generate a massive, sustained upward price swing just to validate the entry setup. This deep capital exposure requires the trader to sit through minor pullbacks and volatility spikes, actively calculating if the structure is failing or just breathing. We solve this by detaching the risk anchor from that extreme low. Risk is not a static requirement dictated by the bottom of a candle. It is a geometric variable that we can manipulate. By simply lifting that anchor and locking it directly into the exact center of the impulse block, the entire mathematical profile of the trade shifts. This single adjustment forms the foundation of the DRW architecture. It is a multi-part automated execution pipeline, engineered to cut risk in half, objectively trail stops to break even, and structure payloads for trend capture. Moving the stop loss from the extreme low to the midline replaces a subjective guessing game with a geometric certainty. To understand how the pipeline operates, we have to start by isolating the geometry of that initial impulse candle. This isolated diagram displays what we call the 50% invalidation midline. This coordinate acts as the strict, non-negotiable anchor for the initial stop loss. Placing the stop here means the initial unit risk, our 1R baseline, is sliced exactly in half at the precise moment of execution. This exact compression creates an immediate, highly asymmetrical advantage for the position sizing engine. Because the point distance to the protective stop is now halved, the sizing engine recognizes the reduced exposure and can safely load double the amount of contracts onto the initial setup. You gain double the upside leverage on the contract side, and you achieve it without risking a single additional dollar of portfolio capital. There is a secondary geometric advantage at play here. By halving the unit risk, the upward price distance required for the market to validate the trade and strike that 1R target is also cut in half. The position reaches its first crucial profitability milestone very early in the momentum cycle, frequently before the price action even approaches standard early-stage profit lines. Midline anchoring structurally rewires the math of the execution. The trade is highly likely to reach its first protective coordinate before the setup experiences a structural failure. Once the entry logic is set, we move into the dynamic execution phase. This is where most systems fail due to the subjective nature of deciding exactly when to trail a stop loss. Move the stop too quickly, and minor volatility knocks you out. Wait too long, and a profitable position reverses downward, consuming the initial risk capital. As this terminal chart animates forward, we see the solution, the 1R breakeven milestone. This objective coordinate completely eliminates the trailing dilemma. Because 1R is anchored to our compressed 50% midline, touching this green coordinate means the market has paid back 100% of the initial cash risk. That exact touch fires an uncompromising mechanical rule in the architecture. The system automatically detaches the stop loss and trails it upward, locking it exactly at the initial entry price for the entire position payload. Crucially, at this coordinate, no actual contracts are sold. The entire payload remains active on the board. The position retains its maximum possible volume as it heads toward higher extension targets, but it does so without risking a single dollar of the initial stake. The architecture instantly transitions from a state of active mathematical risk into a completely free position. From this point forward, the absolute worst-case statistical outcome is exactly $0. With capital protection secured at the entry line, the architecture focuses entirely on the macro position payload designed to extract long-term trends. Zooming out on this chart to view higher extension targets, we can see how the sizing engine divides that doubled contract payload. It splits the volume into 3 strict execution roles to optimize the final yield. The first stage is Tier 1, or T1, which handles approximately 25% of the total position payload. T1 is mechanically closed at a 2R distance, the equivalent of one full candle's volatility expansion. This action removes initial capital from the board and secures immediate, bankable cash. The next 25% of the payload belongs to Tier 2, engineered specifically to capture the primary impulse momentum. T2 automatically closes at the 4R distance. This books a significant momentum gain before wider market volatility has time to set in and degrade the profit margin. This leaves the final and most powerful segment of the architecture, the core runner, consisting of the remaining 50% of the original payload. The core runner is held exclusively for macro trend runs. It is designed to capture 100, 200, or even 300 points of NASDAQ extension. This massive macro exposure is entirely shielded by the risk-free break-even stop we established back at the 1R trigger. This three-tier scaling architecture guarantees structural consistency. Early capital protection at T1 directly funds the opportunity to ride massive macro trends entirely without stress. The DRW pipeline functions as three interconnected systems: 50% midline anchoring to halve the initial risk, the objective 1R break-even trigger to protect the capital, and a three-tier scaling architecture to extract the momentum. Here is that entire mechanical sequence operating in real time, a perfect progression from entry to macro extraction, running on cold math. Implementing this strict quantitative pipeline shifts trading away from a stressful tick-by-tick gamble. It operates precisely like an institutional assembly line. You are no longer sweating over every minor pullback. You know your initial risk is mathematically compressed, your trailing milestones are entirely objective, and your exposure is managed for you. Lock in the mathematical midline, wait for the 1R trigger to transition into a completely free position, and let the core payload surf the momentum.